Hey everyone, I am Kelly Goekjian with Cannon Financial Strategists. Leah and I actually met in college here at UGA. I'm here in Athens, Georgia, and became fast friends. And she's been my best friend ever since. So it goes without saying that I am super excited to partner with her while she's out on maternity leave. So thank you all for being here. Today's session is called Financial Wellness. We chose that title because ultimately that's what we hope for all of you to achieve. It's not just about earning a good income, it's about feeling really confident and in control of your financial life. So, one thing that we know about real estate professionals, because we work with a lot of them, is that your financial lives are different than most people. Your income is not always predictable. It can be up some quarters and then a little bit slower in other quarters. And then also, you're responsible for managing your own taxes, your retirement savings, your investments, and then your cash flow in and out of the business. And we know that at times that can feel really overwhelming if you don't have a partner. So the good news is that a lot of times with complexity, we also have a lot of opportunity. And that's how we feel about your industry. There are strategies that are available to you guys that are not available to us, kind of your typical W-2 employee. And so our goal today is to help you understand those that you have, and maybe get you thinking about some things that you've never thought about and give you some practical ideas that you can either start thinking about today or start implementing today. Before we jump in, I just want to tell you a little bit about our firm, Cannon, because we do things a little bit differently. If you go to a typical investment planning or financial planning firm, that is all they do. And while certainly we do manage investments for people, we also have expertise in retirement plans and in tax planning. I spend a lot of my time working with small businesses and institutions so that they can design retirement plans for their employees. I also oversee our tax practice. And so, because those three areas, both financial planning, tax planning, and retirement planning, because they all work together, we believe that our clients receive more comprehensive advice than if all those services were separated and you were going to three different offices to get those. We've been around since the mid 80s. We started specializing in retirement plans. That grew to wealth management, and then that grew into tax planning. And so we're going to have a piece of each of those today to talk to you about. You'll hear from three of my colleagues today. So they're going to cover different pieces of this financial puzzle that we're all trying to put together. First, you're going to hear from Mac Wages. He's the head of financial planning here at Cannon, and he's going to talk about saving and retirement planning, basically how to create a strategy when your income isn't consistent and how you can make your money work for you so that you can retire comfortably. Kind of what are those benchmarks that you need to be meeting, and then how can you implement it? Next, Ian Payne is going to talk about investment. Saving is the first step, right? And then it's like, what do we do with all that money? And then how do we assess that and do it appropriately? So Ian's going to cover some of the key principles behind building an investment portfolio that makes sense for you. And then finally, Kevin Van Sice, he works as an advisor, but he also sits inside of our tax practice. This is kind of the pain point for everybody, right? You're having to manage your taxes as well. And so he'll share some strategies that can help you better prepare for tax season and hopefully reduce your tax burden or at least make it a little bit easier for you to implement some things to make it easier. We will save a few minutes at the end, so if you have some specific questions, just jot those down as we're working through everything. We're happy to answer that. Thank you again for joining us. We hope you leave with a couple of nuggets that'll make you feel more confident or that you're asking yourself more questions about your business. And with that, I'll go ahead and turn it over to Mac.
Super. Thank you, Kelly. Well, like Kelly mentioned, my name's Mac Wages. I'm the head of financial planning at Cannon. And really what that entails is supporting our advisors as they create and then implement financial planning for not only all of our clients, but then for the retirement plans that we service, any plan participants. And so on average, we help about 400 households a year with any kind of financial planning issue, from creating a balance sheet to a retirement income projection. Some of the basic questions I want to try to answer in this portion of the presentation that you may have would be, what does it look like to save for retirement? How do I manage risk as it relates to not only my personal risk, but maybe my business risk or my investment risk? What's the best way to save for retirement, considering my income variability? So we've got two questions there. How much do I save? And then where do I save? What retirement account is right for me? Should I be doing traditional or Roth? As a business owner, how much cash should I be keeping on hand for emergencies? How do I save money on my taxes? All of these are things that business owners and individuals who are 1099 have questions on, and if we're getting more fundamental than that, just people in general have questions on, how do I make sure I'm set up well for retirement? And that's really what the question I'm trying to answer today. Whenever we talk about saving for retirement, there's actually two things I want to do as like a prologue before we get there. The most fundamental thing we want to make sure we have down before we begin saving is debt management. And so really, if you have any high interest debt, so that could be credit card or really anything with above about a 10% interest rate, we're going to be hard pressed to recommend you save for retirement while you still have that debt. And that's just because on average, we would expect the stock market not to exceed that interest rate in a given year. So we'd rather save 10 cents by paying off our debt than put money in a retirement account and save for retirement. It also helps free up cash flow. Getting rid of some of that debt can help with personal cash flow and business cash flow as well. So take a look at your personal balance sheet, see if you've got any high interest debt, try to eliminate that. Business debt, I kind of consider that as a separate item entirely. And so if you have any kind of business debt, you can kind of exclude that. Right now, what we're looking at is just personal balance sheet, personal assets, and making sure we have all the high interest debt taken care of. Once that is out of the way, the second thing before we get to retirement savings is your emergency fund. And the question I like to ask everyone as it relates to how big their emergency fund should be is, how important is your income to your household? And that will really determine how large your emergency fund needs to be. The textbook answer is 3 to 6 months of expenses. Of course, there are many exceptions to this, right? And so there may be things about your own personal financial situation or personal balance sheet that would dictate you could have less or more in an emergency fund for that to be appropriate. If you're the only breadwinner in your house, you're the only source of income, we're going to recommend closer to 6 months worth of expenses for that emergency fund, just because if something happens and you can no longer work, maybe you get in an accident and you have to be out of work for several months, we want to make sure you have a long runway to get back into work. If there's someone else in the household that makes a comparable salary or income to you, then 3 months of expenses is appropriate, just because presumably they'll be working while you're out of work. And again, you still get that long runway. So again, textbook answer, 3 to 6 months of expenses. Note, this is expenses, not income. Really, when we're looking at this, we want to say, all right, what would a kind of a shoestring budget look like if I ended up being out of work, and then go based off of that. Okay, so once you have that high interest debt taken care of and then the emergency fund set up, let's start looking at contribution methods for those retirement accounts. The next slide will deal with the specific types of retirement accounts, but let's discuss how we can contribute to retirement accounts. The first method I like to recommend is just what's called the excess cash method, or the cash sweep method. So as an example, let's say you make $2,500 per pay period. What you could say is, okay, I'm going to live on $2,000 and then sweep that extra $500 to a retirement account. If you got a raise, let's say you got a raise to $3,000 a pay period, you're still living off the 2,000, but then you're going to sweep that extra 1,000 now because you got the raise to a retirement account. The second method is going to be comparable, but not exactly. It's going to be the percentage method. It's where you take a look at your income and say, okay, I'd like to target saving about 10 or 25% of my income to a retirement account. I actually prefer this method a little bit more because it allows you to get a cost of living increase as you do well and sell more houses and make more money. So let's say you're making $3,000 per pay period. You decide, all right, I'm going to save 10% of my income. So you're saving $300 and you're living off the 2,700. Let's say next year you do really well. You're making $4,000 per pay period. You're now saving 400 and you're living on 3,600. So as you make more, you proportionally save more while also retain the ability to get a cost of living increase and enjoy really the fruits of your labor. The last method is going to be the quarterly contribution method. This may be particularly useful for those of you who are making quarterly estimated tax payments. And so every quarter when you go to meet with your CPA, if you use them to file a quarterly estimated tax payment, or just with yourself, you evaluate your cash on hand and say, okay, I think my quarterly tax payment is going to be this. I have this much extra that's built up in cash that I can then contribute to a retirement account. And maybe you even have a target where you say, all right, every quarter I want to ideally have built up $1,000, $5,000, $10,000 to contribute to a retirement account. What I will say is that kind of the king of all of these is automation. At the end of the day, it doesn't really matter what method you use, so long as you are contributing to a retirement account. Ideally, we'd like to contribute more rather than less, but as long as you are contributing, and ideally you're automating contributing to where contributions are coming out automatically, you're not having to think about it, that is really going to help you be a consistent saver. Okay, now I want to briefly discuss a couple different types of retirement accounts. The following slide, I'll discuss whether to do traditional or Roth contributions. So right now we're just looking at the types of retirement accounts. The first one is going to be probably the most familiar to all of us on here, and that's going to be the traditional or Roth individual retirement account, otherwise known as an IRA. The contribution limit for that is going to be $7,500 for most people. If you're over the age of 50, you can contribute $8,600, so an extra $1,100. Income limits don't exist if you don't have access to an employer plan. So think a 401k, 403b. What's also really neat about IRAs is you have the ability to do a spousal contribution. So if your spouse does not work, if they do not earn an income, you can still contribute to an IRA on their behalf. Next up is going to be the SEP IRA. I like the SEP IRA for people who are already maxing out the IRA and want to go above and beyond. The contribution limit for a SEP IRA is going to be the lower of $72,000 or 25% of net self-employment income. So as an example, let's say you have $100,000 of net self-employment income. And remember, this is net income. So this is not the top income figure. This is net after all the deductions and things have been taken out. So 25% of that is going to be $25,000, meaning that's the most you could put into a SEP IRA. Let's say you're a very high income earner and your net self-employment income is $400,000. 25% of that's $100,000, but we've got that $72,000 cap that you can't exceed. There's no income phase outs for the SEP, so it doesn't matter really how much you make. Compared to the solo K, I prefer the SEP because it's a little bit more administratively easier to set up and run. However, if you're maxing out that SEP, or let's say maybe you're kind of hitting the limit of that 25% of net self-employment income and you're wanting to go above that, the solo K can be useful because you can go above 25% of net self-employment income. However, once you do the solo K, there's a little bit more administrative work that needs to be done. But again, very good for super savers. And you can do employer and employee contributions. So it lowers both personal and business income. The last type of retirement plan that I'll mention here is going to be a custom retirement plan. So think a defined benefit or a cash balance plan. These are really for individuals who are ultra high earners and wanting to save, $100,000 plus a year. And so these administratively are going to have the most requirements. However, they're going to allow you to save the most. So wouldn't consider those for anyone unless you're maxing out either a SEP or a solo K. For all of these retirement accounts listed, really at the end of the day, it's going to be great to contribute to them because you're going to get some sort of tax benefit. You do a pre-tax or traditional, you're going to get the tax write-off. If you do Roth, then you get the tax-free growth and get to pull that out in retirement tax-free. I do also want to briefly mention the brokerage account. It is not a retirement account. I like to call it the checking account of investment accounts. You can put as much money in as you want. You can take money out whenever you want. So there's no income or contribution limits whatsoever. So you have immediate access to the funds. And two, what's also neat to mention is you have capital gains tax treatment if you hold investments for a year. So for just about everyone, your capital gains tax bracket will be lower than your ordinary income. So take me, for example, my ordinary income bracket's 22%, but my capital gains tax bracket's 15%. So I can save 7 cents on the dollar if I have capital gains rather than ordinary income. Okay, so I briefly mentioned, the tax benefits of contributing to a retirement account. Um, should I be doing Roth? Should I be doing pre-tax? A lot of ink has been spilled on what to do and when to do it. Really, the question of whether to do Roth or pre-tax can ultimately just be boiled down to what will my income tax bracket be in retirement. So let's, for an example here, I'm going to use round numbers. Let's say in retirement, you expect your income tax bracket to be 22%. And let's say starting off early in my career, I'm working. You can see this is kind of a timeline here. So the horizontal axis is early career, and then it moves over to middle/late career. And then the vertical axis here is tax bracket. So early in my career, I'm not making a ton. That's that first job I get. That's working in a department store. That's working for maybe a small business in the town I grew up in. My tax bracket's low. It's 12%. So I'd rather do Roth, pay the taxes up front at 12%, and then pull them out in retirement tax free at 22%. I save 10 cents on the dollar there. I pay the tax at 12, I pull them out tax free at 22%. But then in the middle of my career, I go work for Keller Williams. I'm selling a bunch of homes. I'm doing very well. And my tax bracket goes way up. I'm now in the 32% tax bracket. Well, now I would rather do a pre tax contribution or a traditional contribution because I'm getting the tax break on the contributions. So I'm contributing at the 32% bracket. I'm saving 32 cents on the dollar, but then I pay taxes later at the 22% bracket. So again, the question whether to do Roth or pre-tax is just a tax bracket question. Is my tax bracket now higher or lower than what it will be in retirement? All right, let's go through one or two quick examples here. So let's say you're making $250,000 a year, 250,000. What would it look like for you to save for retirement? Maybe even save aggressively for retirement. Well, you could set up that solo K and do $24,500 of employee contributions, and you could do an additional $47,500 of employer contributions. So remember, with the solo K, you can do employee and employer, and it's not limited by net self-employment income. If you're over the age of 50, you can also do an additional at least 8,000. For individuals who are 60 to 63, you can go even above that. Then I also want to shift over to the Roth IRA. You could do an additional $7,500 into a Roth IRA or a traditional IRA, and then there's an $1,100 catch up on the Roth as well. A neat thing to mention about solo Ks and Roth IRAs is they're tax sheltered. So let's go back to that brokerage account. Anytime I'm trading in the brokerage account, I'm more than likely going to be generating capital gains and have to pay taxes on that. The solo K, the Roth IRA, and essentially any retirement account we just listed other than the brokerage account are going to be tax sheltered, meaning I can trade freely in those accounts and I'm not taxed on trades. I'm only taxed when income is distributed to me in retirement. So that's what we mean when we say tax sheltered down here. Lastly, the brokerage account. So you can see here, we're already saving aggressively for retirement. We're saving at this point between the solo K and the Roth, $79,500. The brokerage account allows me to go infinitely above that. I can put as much money into that brokerage account. Again, just with the understanding I'm getting no immediate tax benefit. It's not tax sheltered, but the benefit, again, no contribution limits and capital gains tax treatment. Okay, so the question now is going to be how much do I need to save to retire? So a general rule of thumb is going to be what's called the 4% rule. Basically, what it says is on day one of retirement, we expect that you could withdraw 4% of your portfolio a year safely and have little risk of running out of the portfolio. Of course, there are extenuating circumstances, and sometimes that does happen. So what you would want to do is take your desired retirement income or how much income you'd want to pull out of your retirement portfolio, divide that by 4%, and that will give you the required portfolio value on day one of retirement. So let's go through a quick example here about Paul. So Paul is a Keller Williams agent, and he wants to fully replace his monthly income of $12,000 at retirement. His Social Security benefit is $3,000, and he also has two rental properties that produce $2,500 per month of income. How much does he need at retirement to fully replace his pre-retirement salary? So he needs $12,000. $3,000 of that's covered by Social Security, and then $2,500 of that is covered by his rental properties, meaning that he needs $6,500 from his portfolio. So again, he doesn't need the full $12,000 because he's got other income sources. What we'd want to do is take the $6,500 times 12 months and then divide that by 4%. That gets us $1.95 million. So again, 4% of $1.95 million is basically a safe withdrawal rate, we think, for Paul out of that to be able to replace some of his income. What does it actually look like to save? How much would Paul need to save in order to get to that figure? Well, let's say Paul's currently 30 years old and wants to get to that $1.9 million figure. How much does he need to contribute now versus if he waits? To get the same amount at retirement, if Paul begins contributing at age 30, he needs to save about $10,000 a year. If he waits to age 40, that amount doesn't just double, it goes up by almost 2.5 times. So he needs to save over $24,000 a year. And then if we look at the total contribution, so if we look at the total amount of money that Paul's putting into his investment accounts, if he starts at age 30, he can put in 364,000 to get to that $1.9 million figure. If he waits to age 40, he has to put in almost $250,000 more to get the same amount of money at retirement by just waiting 10 years. So again, this really just shows the power of compound interest that by saving earlier, even if you're saving less, even significantly less, time is your friend and time is on your side. Okay, now I want to pass it over to Ian Payne. We've talked a little bit about saving for retirement. What happens if I am saving for retirement? The money's in the retirement account. How do I decide what to invest in and what's appropriate given my age and my goals?
Thanks, Mac. So Mac's given us the roadmap to getting the accounts opened and funded. So now, how do we allocate the dollars that we've worked hard to be able to contribute to these accounts in order for them to accomplish the retirement goals that we have, or the future financial goals that we have, rather? And so the first step to that is, of course, establishing the goals. So what are the goals for our portfolio? For some folks, it's just I want to maintain my current lifestyle in retirement. Think Paul as our example. That was his goal, right? Some people want to be able to move to the beach in retirement. That's the main goal that's outstanding for us. Some folks want to say, I just want to grow my real estate portfolio as aggressively as possible, and the retirement thing will figure itself out. That's still a financial goal that we want to make sure the portfolio is working towards. And a lot of people want to retire early at 45, or at least have the financial flexibility to do so. So these are all some examples of goals, but of course there are a lot more than this out there. The next thing we want to think about is, what is the time horizon for that goal? When do I want to achieve it? The person that wants to retire at 45, they have a clear time horizon depending on their current age. We take the time horizon and the goal itself in order to figure out how do we allocate the portfolio given those two facts. We think through what is our risk tolerance and our risk capacity. Our risk tolerance is our personal feelings around taking risk in investments. If we have a high risk tolerance, we're more apt to be more aggressive with our investments. If we have a lower risk tolerance, we are often more conservative with our investments. And then the capacity is the amount of risk we need to take in order to accomplish the goal given our time horizon, right? So all these things work together and are all important factors when we think about how to allocate a portfolio to accomplish those goals that we've laid out for the portfolio. So now I want to talk a little bit about those publicly traded asset classes. Most of these publicly traded investments fall into three categories, and there's some other alternative investments we'll also speak to as well here in a second. But in the public markets, on the x-axis, we have our potential risk. On the y-axis, we have our potential return. And unsurprisingly, we see a positive correlation between risk and return. As we take more risk, we expect there to be also a higher potential for return. Starting in the bottom left here with cash. Cash is our lowest risk, but also our lowest potential return asset class. Think your money market accounts. Think your high yield savings accounts. Anything really short term, there's very little to no risk in these investments. And so therefore, these are where our emergency fund that Mac talked about. This is often where we want to allocate those dollars. We don't want to take risk with our emergency fund. So there's still a place for cash in the portfolio, but again, is our lowest risk and lowest return asset. So the next rung up the ladder are bonds, and bonds are very similar to our mortgage. Mortgage is a type of bond. You can actually buy something called a mortgage-backed security, which is a publicly traded basket of mortgages. In our mortgage, the bank lends an individual dollars to go buy a property, buy a home, buy a piece of land. And the bank then has that piece of land or that home to back the debt that they have now lent out. And so if the individual can no longer make the debt payments, the bank has lower risk because they have the asset behind it that they can then take ownership of and then liquidate in order to satisfy the debt. So there's limited downside that can be had for debt holders. Same thing as for companies. In the event a company goes bankrupt or has a liquidation event, your debt holders get paid before your ownership, your stockholders and the people that have ownership in the business. And so there's less implied risk, also less implied return there as well. Now, within bonds, there are a lot of different kinds of bonds. I mentioned mortgage-backed securities are a type of bonds. High yield bonds are another type of bonds, also called junk bonds. These are higher risk bonds, but also pay us a higher yield. So within the bond universe, there's a lot of things that from a risk return perspective that exist in that asset class. The same goes for stocks, and stocks is our ownership in a company, also called equity in a company. Um, when you own a stock, you truly represent a piece of ownership in that business. A lot of times those stocks come with voting rights for the board in these shareholder meetings. And so it really is a piece of ownership. It's not just theoretical ownership, but with ownership comes a lot more potential return, but also a lot more risk. Your downside is much lower than those bondholders because you're riding the ups and the downs with the company. If the company goes bankrupt, you may or may not get your money back. And so to compensate for that, there's also the higher return. Now, know what you may be thinking, where does real estate fit into this? Well, that's what we call a alternative asset class. Now, alternative asset classes don't really fit on this chart because there are so many different kinds. Think cryptocurrency is an alternative asset class. Real estate is an alternative asset class. Gold or precious metals is an alternative asset class. And these things all can have a place in a portfolio depending on the risk tolerance, the risk capacity, and the goals that we set out for our portfolio. And they can also provide us with additional diversification than just any of these publicly traded asset classes. And so, on an individual basis, on each person's scenario may be different, and whether they need, what percentage of publicly traded to alternative asset classes to accomplish the goal. But all these things are still important when considering how to allocate the portfolio. So, how do we gain access to those different asset classes? Well, of course, we can buy individual holdings. I can go buy one Walmart stock if I want to. Right now, I have a piece of Walmart. You can actually go buy individual bonds, through a brokerage like Schwab or Fidelity, and you can own an individual bond. A CD is a type of bank bond that you can own as well. So these things you can hold, individually within your account. The difficulty there, however, lies in diversifying those holdings. When we own the individual holdings, oftentimes it takes hundreds or thousands of these holdings to achieve diversification in our portfolio. And this can also get expensive, right? Think if one stock is a couple $100 and we need 100 stocks to diversify our portfolio, we're already in the tens of thousands of dollars just to diversify our portfolio. So it can get expensive and also tedious from a management standpoint. And so we can access diversification, simplicity, and lower cost thresholds to get into these different asset classes through investment vehicles. And these are your mutual funds and your exchange traded funds or ETFs. Most folks have heard of these, and these are just baskets of individual holdings that are often accomplishing a specific goal. So like I mentioned, it has that easy access to diversified portfolios through many, many holdings. And there's also, like I mentioned, a declared investment strategy. So if you own a large growth company mutual fund, you'd expect that mutual fund to hold large growth companies. If you own the S&P 500 ETF, you would expect that exchange traded fund owned the 500 companies in the S&P 500. And so it's easier then to achieve your diversification, not only within the specific asset class itself, but also on a whole, right? If I want to allocate and diversify my equity holdings, I can buy different areas of the equity market through anywhere from 5 to 10 to 15 exchange traded funds rather than having to buy thousands of individual holdings to do so. And all the retirement accounts and brokerage account also that Mac mentioned earlier can hold these different kinds of investments. So if you want to have the individual holdings, you certainly can get those. You can also access mutual funds and ETFs there as well. Okay, so a little fun thought experiment about real estate fitting into the portfolio. I figured this was applicable given who we're speaking to today, and it's a fun experiment to look at and data set to observe. On the y-axis, just to orient us a second for what we're looking at, on the y-axis we have volatility, just a measure of risk. Higher volatility, the more the price of the investment moves up and down, and then return on the x-axis again seeing that positive correlation that we talked about earlier, higher risk, higher return. Closest to the bottom left, there are core bonds. These are your vanilla, very high quality bonds, but because they're high quality with less implied risk, we don't have as much return. That's okay. That's their place in the portfolio. So we move up and to the right a little bit. We see high yield bonds. I mentioned those earlier. We are taking more risk within the bond market, so still less risky than your equities, but we're taking on a little bit more risk and we expect to get compensated with some higher return. Also want to mention this chart is the past 15 years specifically, in which it was intentional because housing has done very well the past 15 years. And so housing looks really good on this chart. The next uh, bullet point we see to the right of high yield there is unlevered housing. So this is going out and buying a property with all cash, right? So no mortgage, no debt instruments to do so. We're completely unlevered. We're buying a home with cash. The return on that's been a little over 9% the past 15 years, with lower volatility than high yield. So it's been a great asset class to own over the past 15 years in a portfolio. We move further to the right and a little bit higher up there, large value companies. These are your Walmarts, Home Depot, Coca-Cola. Those are examples of large value companies. Further to the right and higher up the volatility ladder as well, small value. These are your regional banks. Your small manufacturers fit into this area of the equity market. And then further to the right, there's large growth. These are your big tech companies that have done very well recently. Think NVIDIA, Apple, Amazon. And you'll see just south of that large growth bullet point there is levered housing. So this is 50% leverage used to buy housing. It's actually been the best performing asset class compared to all the others over the past 15 years. We've had really good returns out of that with even lower volatility and large growth. So there's no doubt that housing, and we're using housing as a function of real estate here, has been a really good asset class the past 15 years. But when we take that out over a longer period of time, a more typical retirement timeline for someone, let's say 35 years. So this goes from starting last year all the way till 1990. We see that the dots get closer around that positive correlation that we expected. The ranges tighten up, which we would expect over longer periods of time. So we see core bonds there, right in its rightful place, lower returns, but lower risk, lower volatility. So we move up, we see high yield and unlevered housing perform very similarly over a long period of time. So these two things, when we are allocating to our portfolio, we may not want to hold both of these items because they're not actually diversifying each other. They're performing very similarly over a long period of time. So we may want to hold one or the other. And if we hold both thinking we're good at diversification, we may actually be concentrating our risk because they perform so similarly. We move further up and to the right there. There's our levered housing over the past 35 years. And then we start to get into our equity holdings further on the right. And so also want to point out that real estate does have a place in portfolios. And as you can see with levered housing there, and also the unlevered housing kind of starts to fill the gap between bonds and stocks. And that is where we expect real estate to provide us that additional diversification because it fills in that gap. It also provides us income oftentimes, but it really fills in that gap between stocks and bonds. And so it can provide us additional diversification. Again, we just don't want to concentrate it too heavily, just like we would not concentrate at any one of these investments here on the graph. We want to diversify, and real estate has a place as long as it's diversified alongside everything else. So I'm going to turn it over to Kevin to talk a little bit about tax planning and business structures. He's going to give a lot of wisdom here. So Kevin, take it away.
Thanks, Ian. So I'm here to talk about tax planning. I'm a financial advisor at Cannon. I work under the tax practice. I work directly with Kelly Gertron quite a bit. So happy to be presenting to you guys today. I appreciate your attention. And I'm going to try and keep this high level. It's my focus to help you understand some of the obligations you have as a self-employed person as it relates to taxes, payments, filings, etc. And to also illuminate maybe some opportunities you have to save on your overall tax burden. So as a 1099 contractor, this has been touched on, but you are both the employee and the employer, right? So to illuminate some key differences between what maybe your situation and the W-2 employee situation look like, let's take a look at self-employment taxes. The W-2 employee pays 7.65% FICA taxes, and the employer is paying the other portion of that total 15.3% bucket. And FICA taxes pay for your Medicare and Social Security benefits. That's what FICA is related to here. As a self-employed person, you're both the employee and the employer, so you're paying both portions, right? And this is a large reason why your tax bill might feel really big if you've ever made that transition from W-2 to a 1099 self-employed person, right? It can be quite scary when all of a sudden your taxes are so much higher. That and it's not taken out automatically. So a lot of people often get hit at the end of the year not knowing how much they owed. As a W-2, usually you have a payroll system that's just automatically deducting those FICA taxes. You don't have the same benefits necessarily as a self-employed person. Um, so since it's not getting automatically deducted, let's take a look at estimated payment requirements. The IRS is expecting that you're making payments throughout the year, and they assume that you make income evenly throughout the year, right? And that may not necessarily be the case. So let's talk about it. Quarterly due dates, each quarter have the dates listed here that you need to make payments by. If you do not pay evenly throughout the year, that could end up resulting in some penalties. Um, if you don't pay the full amount, if you don't pay anything, you get to the end of the year and it's like, okay, CPA, tell me how much I owe. You know, you may owe penalties to the IRS for not having made those payments throughout the year as they expected. So there are different kinds of penalties. Failure to file, failure to pay, underpayment. This is probably the most common that you may run into as a self-employed person. And then I'll talk a little bit about uneven payments too. Again, they assume that you make an even income. If you're selling real estate, for example, maybe you have a banger quarter. Q2, you're selling in the spring and early summer, and people are out there buying houses. And then maybe it's a little slower in the winter months, right? There's tools to manage this. Draw your attention to that bottom note about safe harbor rules. We may not know how much we're going to owe necessarily in any given year, but we might understand how much we paid last year. And you can see if you pay 90% of the current year tax liability, you get close to what you owe for this year. You're generally not going to owe penalties, or you're going to greatly reduce how much you're going to owe in penalties. Or you can pay 100% of the prior year tax liability. So we'll know what the number we paid is last year. We can pay 100% over those 4 quarters and help us really reduce the penalties that we may be subjected to. So that's just a quick tip to try and help you manage tax payments, right? While you may have additional costs through FICA, you also have additional opportunities to save on your taxes by reducing your income with key deductions, right? So I'll go top to bottom, left to right here. Some of you may be familiar with vehicle and mileage deductions. If you're driving for a business purpose, you're going to a property showing, an open house, client meetings, to the store to pick up supplies, you can deduct the mileage that you go for that business purpose. You might even consider getting a device or an application to help you track those. Some of you are probably very familiar with this and you've figured out your own system. But if you haven't been using a device or an app, that's something to strongly consider. And just continuing on this, marketing regular business expenses. Maybe you're building up your social media profile. Maybe you even have a team that helps you manage that. You're buying signs, you're doing photography, you have software, you have a website that you're managing, you're making business cards. You have various different expenses, and usually a lot of these things can be deducted from your income to reduce your overall tax liability, right? Home office, this is one that we commonly get questions on. People hear about it, they're like, oh, I work at home. I hope that I can make a deduction for, a portion of my home expenses based on where I work. The IRS does allow you to do this, but they have clear guidelines, right? The space that you use for work purposes must be used regularly and exclusively for your business, right? So if you have a guest room that you host people in from time to time, maybe this doesn't qualify as an exclusive use, home office deductible expense. A lot of people will say, I use my kitchen table. It's not something that you use exclusively for business, so maybe it's not deductible, right? And then here's just a quick listing of maybe some other additional deductions that you didn't consider before. So you might want to take a picture of this, save it for later. Again, we have callouts on the bottom right-hand corner. Consider that mileage tracking app and device. But one way to help you manage these deductions, ensure that you are maximizing, the deductions that you are owed. You have to pay these expenses to run your business. You're going to pay these expenses. Let's make sure that we get the deduction that we're eligible for, right? You can open up a separate business checking account or even have a separate business credit card, for example, so that all of your expenses are in one place and not commingled with household assets or household expenses, rather, right? So it's all separate. You get to the end of the year, the CPA says, "What are your expenses?" Some people might be saying, "I don't know." If you have it separated, it's easier just to give them a statement and say, "Here you go. Here's everything." Um, and with all of these deductions, proper documentation is necessary. If you're claiming deductions without documentation, you can kind of think of it like speeding. If you don't get caught, cool, you get the deduction, but at some point down the road, you get audited and you don't have the documentation to back up the deductions you claimed. Could mean penalties, repayments, and depending on the severity, maybe even legal recourse. So let's be consistent with our documentation and make it a priority. Uh, the next thing is talking about entity structuring, right? Maybe you've heard a little bit about S corps. People have said this is a great way you can save on taxes, or maybe they say it's a huge burden. You should not use this. Let's try and demystify this. I want to help you understand the benefits of using an S corp potentially, the situations where it might apply, and some of the things that you have to do to effectively run the S corp, right? So an S corp in and of itself is not an entity. Usually you'll have an LLC and then you can elect to file your taxes as an S corp. So this is a tax filing election that can potentially reduce your overall tax burden by allowing a business owner to separate their net profits into reasonable salary and profit distributions or business income, right? So a quick example to kind of to illustrate a very simplified example of how this might work out. Say you have $200,000 in net profits as an agent. You're going to pay 15.3% in FICA taxes on that entire net profit, right? So big tax bill, $30,000. But as an S corp, you can actually split these out. So you can split your net profits into reasonable salary and business income. And then you're only going to pay FICA taxes on that reasonable salary, right? So you just save 15.3% on $120,000 by classifying that as a different type of income. So that can be a very meaningful tax difference. Again, this is a super simple example. There's other factors that come in here. Maybe you're losing out on some deductions, whatever. So it's not exactly one to one, and I don't have to pay 15.3 on 120K. But this is the concept. This is when an S corp might be good for someone. So let's talk about, when does it make sense? It doesn't make sense for everybody. If you're just getting started, income's really variable. You don't have the feel, the flow of things yet. Maybe you want things to settle. You want to settle into the role before you get started with an S corp, and you want to be consistently profitable. Usually, the range where an S corp, after any added expenses and the time that you have to put in to manage the S corp, usually you want to be making around $75,000 to $100,000 or more before the S corp really begins to yield some benefits for you. There's also additional things to manage as an S corp, as I mentioned. So you're filing an additional tax return. You're going to have your personal tax return and your business tax return. And that can be difficult to do on your own, especially if you're not experienced. You may even consider outsourcing it, and then now you have an additional cost, right? Two tax returns, more of a cost if you're outsourcing the filing of your taxes. There's, of course, additional record keeping with all these things for you self-employed people. You have to be keeping your records tight, and this is no different. And you even actually have to set up your own payroll. So just like a W-2 person who's getting a salary has a payroll, you have to set up a payroll for yourself as a self-employed person with an S corp. So this means potentially quarterly and annual filings, maybe self or unemployment insurance is something that you have to consider too, which a lot of people don't expect. And you got to issue yourself a W-2. And just to highlight, I've been saying reasonable salary. What does this mean? This is kind of the question that a lot of people ask. It's like, I make 200K net profit. I think reasonable for me is 30K. So now I'm only paying 50.3% on 30K. that may not necessarily fly with the IRS. You want to think of it maybe in terms of replacement cost, based on my situation, the area I work in, my expertise, how long I've been doing this, whatever. How much would it cost to replace me to perform the same role, right? Maybe someone with comparable levels of skill and experience doing my job, it would cost me 80 grand to to have them fill my role, right? And then you can line that up with maybe what market rates are for someone in a comparable position, and that's how you could think about setting a reasonable salary for yourself, right? So let's take a step back. Let's summarize a little bit. And then I'll also give a few tips in terms of advanced tax planning for people that are maybe a little bit ultra high income or have their own rental properties, right? So the foundational level. These are things that we all can do to help, right? We need to understand our situation. What are our requirements? What are the differences between me and, if I had a payroll system for myself or an employer helping me take care of this, right? We talked about some of that. How do I make quarterly estimated tax payments? When are they due? By doing those effectively, you can avoid penalties and reduce total costs, right? So this is controlling what we can control. Can't necessarily control how many houses we're going to sell during the year, but we can keep expenses low by making sure we're doing those payments on time. We want to document and claim these. We want to document all of our expenses too, so that we can, at the end of the year, know how much we paid and get our full deductions for what we paid for to run our business. And then we also want to think about starting contributions for retirement. One thing to think of too with retirement contributions is you get tax savings from retirement contributions to accounts, right? And you can help level your income. If you're making high income right now, you get a deduction and you expect to make less in retirement, you can kind of even your tax rates, right? And start paying consistent taxes throughout the year so that you're not paying at a higher clip. We're going to level this up, get to the enhanced tier or whatever you want to call it. Maybe we start systematizing withholdings for these estimated payments. We're never running short. We have our emergency fund in place. We're feeling comfortable. And every time we have a cash flow, maybe we withhold 30% to pay those quarterly estimated taxes. We're always going to have that cash on hand. We're separating our bank accounts from the business and personal expenses. We're getting that separate credit card just to have that separation and be able to better manage the documentation and claiming of these deductions on our tax return. That's going to help us maximize our deductions. We're setting up an S corp if applicable, and we're dipping our toes into saving more for retirement with additional vehicles such as the SEP IRA and the solo K. Okay, now this isn't going to apply to everybody, but the advanced tier, maybe you're a super high income earner. Maybe at this point you're maxing out your SEP IRA, you're maxing out your 401k, and you're wondering, how can I save even more on taxes? How can I save even more for retirement? At that point, maybe it's time to seriously start thinking about a defined benefit or cash balance plan. They have levels of complexity. You probably want to consult with some professionals to help you get those set up. But they can be a huge opportunity for tax savings, right? And then I'll call out specifically for real estate owners, for people who maybe have, rental properties. There are some things that you should be aware of. And I'll keep this super high level because they're going to have a lot of disclaimers, a lot of specifics that you need to be aware of if you're going to make effective use of these things. But know that the Augusta rule is the ability for you to rent out your own property to your own business. So maybe you're having a corporate event, you're hosting an annual retreat, and you're going to go buy a space at the Marriott Hotel. You pay them $1,000 for a day to do your retreat. What you could do instead is you could pay, or your business could pay you to rent out your home or your property, and then you could host your event there and still claim a deduction for that business expense, right? Then a little bit more in the weeds here, but cost segregation, bonus depreciation, and then a special tax status called real estate professional status or REPS, right? So cost segregation is the ability for you to reclassify elements of an existing home or rental property to make them depreciable over different timelines, right? And if they're depreciable if they qualify, you can engage in something called bonus depreciation, and you can depreciate the entire asset in a singular year, right? In the year that you put it into service. Normally, these are passive income activities. I have passive real estate rental income. The rep status, the real estate professional status, allows these passive losses to offset ordinary income. And you imagine you combine that with bonus depreciation. Imagine you have $100,000 in depreciation expenses in a singular year. You made 300 grand. That's a big deduction. That's a big tax savings. With those big savings, though, it's not truly, there's some complications with it, right? You claim that depreciation, you're reducing your basis in your home. And if you sell that home, your basis is lower. You're going to pay more in capital gains taxes or ordinary income taxes based on that depreciation. That's called depreciation recapture, right? But it can be an advantage to people who are at a higher income tax rate now than they might be whenever they sell that home, right? So maybe a little bit more in the weeds that I needed to get, but we really appreciate all of your time, right? And want to end off by saying, as a thank you for being Lee Lindbergh's client, we're offering a 30-minute complimentary consultation for you guys. Anybody listening, watching this call, and this would be a space where we could answer any questions you had as it relates to your specific circumstances. We can help you maybe implement some of these things into your own personal situation or just better understand, some of what we talked about here today. So just let us know if you have any questions. You can scan a QR code to get you to a place where you can set up those meetings with us. And then we have some of our information there below. Thank you so much.
Awesome. Thanks, y'all. Hey,